Welcome back. The HDFC Bank stock saw decent institutional buying, probably to the tune of about 2,600 crores yesterday after the management spoke at an investor call organized by Goldman Sachs. Now, what were the key takeaways for investors in terms of EPS growth from this call? And are these takeaways enough to end the underperformance of this stock over the past 2 years? For these and more questions, I have with me Saurabh Mukherjea of Marcellus and Digant Haria of GreenEdge Wealth. Gentlemen, thank you very much for your time. Saurabh, to you in particular, you've, I think, got up early for my sake. Well, for starters, what did you take away from Jagdishan's Q&A?
Latha, I watched Sashi's interview with the Goldman Sachs analyst yesterday, and I met Sashi last week. And our reading is that these guys are confident about the fact that the merger will proceed reasonably smoothly. Yes, there is a liquidity crunch in the system as a whole. It's not specific to HDFC Bank. In fact, in the quarter gone by, HDFC Bank and Kotak Bank were one of the few banks whose NIM held up. The other banks have seen a crunch in their NIMs. There is a liquidity crunch. And I don't think Sashi can be blamed for that. It's a system-wide issue. But Sashi and the HDFC Bank team seem relatively confident of dealing with the consequences of the crunch. The consequence of the crunch is raising deposits has become very hard for all banks, including HDFC, which is why the whole sort of hoo-ha in the market about HDFC's EPS growth basically coming to a standstill as they struggle to raise liabilities in what is a very, very tough market for raising liabilities. I haven't seen RBI liquidity at this sort of deficit levels in my 15 years in India. And Sashi and the team, given the circumstances, are pretty sanguine that they can deal with it. My reckoning is we're looking at NIMs bottoming out for HDFC Bank. We're probably looking at a couple of quarters of single-digit EPS growth for HDFC Bank. And then as they pay off the HDFC liability, as they pay off the more expensive HDFC liabilities which they've inherited, I think we'll once again see NIMs moving forward and EPS growth kick in perhaps 2 to 3 quarters out.
Okay, so you think, therefore, the stock price is condemned to be at current levels at underperformance till they jump to double-digit EPS growth?
I'm not so sure the stock price will stay where it is. These are incredibly inexpensive levels given HDFC Bank's history. You're looking at, I think, 12, 13 times earnings, 2 times book value for a bank which has grown at 20%, grown both sides of the balance sheet at 20% consistently for long periods of time, to trade at system levels of PE, to trade at overall market levels of PE doesn't make sense. India's historical market PE was around 13, 14. HDFC Bank is trading at that when the Indian market itself is trading at 20, 21. That doesn't make any sense to me. My reckoning is we will see institutional buying at a pretty healthy level, even as EPS growth stays reasonably weak over the next couple of quarters. I don't think investors are going to wait for earnings to pick up before they load up on the stock, because the story is really reasonably clear. It's a believable story. It's a clear story that EPS growth will pick up as the liquidity situation improves, and EPS growth will pick up as the high-cost HDFC liabilities, the inherited liabilities, are paid off. So I think the market will in effect buy ahead. The market will buy ahead of the EPS growth picking up for HDFC Bank.
Yep. No, Jagdishan's point that as the old liabilities of HDFC come down or are redeemed, there will be an automatic improvement in the margins is well taken. But Digant, one of the points he very clearly made is that they are going to prefer margins over growth, that they will give up on high-cost deposits. And if you give up on high-cost deposits, you have to give up on loan growth as well. So it clearly is going to be margins more important than growth, loan growth. How would you comment on this statement? How would you receive this as an investor?
So, Latha, thanks for having me. See, I think it's not a surprise that he made that statement that, we have to sacrifice growth in order to maintain margins. Because, see, after the merger, the CASA ratio fell from 38% to 28%. And if you look at last 1 year, HDFC's deposit rates, which it is offering to all kinds of investor, retail, senior citizen, is at least 25 to 40 bips higher than SBI. I have never seen this in my 16 years of tracking the banking sector, that HDFC is so desperate, and they need those deposits because they have to digest a very large merger which was pushed upon them. So I think there is no easy way out of the current situation, Latha, that they will have to fix the deposit side for the next 1 or 2 years. Right now the macro is also very bad. I think after elections macro can become favorable for deposits, but it still takes a few more quarters. I don't see any magic pill for HDFC Bank where it resumes the growth and the margin leadership both. So I think re-rating, if any, will be very, very gradual in this stock.
So therefore you think that it remains at the current price to book of probably 2 or less?
Yeah, Latha, I think that 6 to 9 months will be the consolidation phase where, old investors will be disappointed. They'll get out. The new ones will become hopeful that, oh, this bank is available at cheapest in, last 12 years. And they'll try to come in. But overall, I don't think we'll see much, much action. Maybe this 1350 to 1500 will be the price band for HDFC Bank, because for such a large stock to reverse the negative move that it has had, I think you will need to see either good growth coming back or good margins coming back. None of it is very easy in my view for the next 6 to 12 months at least.
Okay, so around 1450 or 1400 to 1500 is where it might be, you think?
Yes, that's right.
Okay. Saurabh, what's your sense? That's a fair point, that it is an extremely well-owned stock, especially among foreign funds and, of course, even among domestic mutual funds. And therefore, the rise from current levels is not going to be easy. Would you agree?
I think there's a broader story here, Latha. I think if you see the Indian market over the last 4 years, right, there's been this incredible rally in small caps, driven heavily by retail investors. Indian mega caps, by mega caps, I mean the 20 largest stocks in the country, on price to free cash flow multiples, on price to free cash flow multiples, or price to earning multiples as well. Indian mega caps are the cheapest that they've been in 20 years, right? To get HDFC Bank, to get Indian mega caps, generally the 20 largest companies in the country generally at these multiples, you'll have to go all the way back to 2003. So as we move into the downward phase of the rate cycle across the world, I don't think India will be an exception. I think across the world, we should be seeing rates getting cut over the next 12 months or so. As we move into the downward phase of the rate cycle, and as foreign institutional money returns to India, I think we'll see a more general re-rating of mega caps. I haven't seen this sort of disparity in large and small cap valuations in India for a long, long time. 150% rally in small caps in the last, I think, 2 to 3 years has basically taken away any scope for incremental gains there. So I think there's a general re-rating coming for mega caps in our country. I think HDFC Bank will be a part of that. As Digant says, the sooner the central bank relents on the extreme liquidity situation. Remember, HDFC Bank doesn't have a funding crunch in the sense that Nims are holding up. Deposit market share incrementally for them is 16-17%, the highest it's ever been. Smaller banks, smaller private sector banks are facing serious pain on the deposit side. I'm sure the central bank is cognizant of the degree of pain the smaller private sector banks are facing on the deposit side. And given that the RBI has been run very watchfully under Jagdishan, I think Jagdishan has taken extreme steps to make sure that the system doesn't suffer crunches, doesn't suffer blow-ups. I reckon the central bank will relent on the liquidity piece. And distinct from that, I think there's a broader re-rating coming from mega caps in the country. One quick disclaimer, I am invested in HDFC Bank through Marcellus's PMS. So are our 9,000 clients, and so are my parents through Marcellus's PMS.
Oh, yes. Thank you. Thank you very much for that. But I would assume that is everyone's disclosure, every expert we call on the channel. Saurabh, more importantly, do you think there can be larger HR problems? I mean, Jagdishan will have to actually tell those who are bringing in assets, loans, to please slow down because we don't have enough deposits. Do you think there can be an HR churn?
I think there's two different challenges here, and one of them they seem to be dealing with. One is on their lending rates. On lending rates, they've been extremely aggressive over the last 12 months. I think 2 weeks ago, I saw an announcement where they've started pushing their pushing their lending rates up. And my reading is incrementally on the lending side, they will get less aggressive with their rates, partly to protect NIM, partly given that there is a crunch on deposits. Why do you want to be aggressive on lending? So I think we'll see an abatement in the extreme aggression HDFC Bank has shown. I think, when I've traveled around the country over the last 12 months, I've seen on high quality customers, HDFC Banks has been 30, 40 bips cheaper than the other private sector banks. I hadn't seen that before. I think they'll pull back on the aggression lending. And there's a separate issue on ESOPs. The HDFC ESOP has obviously been very attractive for a whole generation of people who worked there. Given that the stock has been weak over the last 4 years, they'll have to think through the compensation construct around staff for whom ESOPs has been a meaningful part of their compensation.
Okay. Finally, Digant, do you think that, the home loan is inherently a low margin product? Would that also be a problem in terms of bringing up their margins?
Yeah, Latha, I think multiple layers of problems, because see, one is when you are offering high deposit rates, you have lower CASA, and it's mostly because you've been forced to digest a very large merger. So not HDFC Bank's fault, but it's just the way things are. I think home loan as a product is definitely going to bite them. And they had these builder loans, corporate loans, which are very high margin for HDFC Limited. Now that will run down under HDFC Bank. So I think there's a lot of pressure, Latha. And let's not forget 2015 to 2020, the PSU banks were not lending, Axis ICICI was not lending. So HDFC Bank had a free run. Things are not like that now, and which is why I think it'll take slightly longer than what we all want it to take. No doubt, it's a great organization, but it's beset with its own set of problems right now.
Just how long will you wait to buy? Level or time? Give me.
I think I'll wait for the time when once first buying can happen when the liquidity cycle eases, as Saurabh was mentioned. The liquidity cycle in the country itself has to ease, and then if there is a micro
just lost
with
it.
an SBI, these are the tracking points where one can build more positions.
Okay, very quickly, Saurabh, when and what level?
I think we're already buying. We've been large investors, and over the last couple of weeks, we've filled our boots up further. You're not going to get companies like this at these valuations for too long. So,
okay, that's most helpful. That's most helpful. Patience is needed on the stock, and it has quite a few problems other than just margins that it has to tackle. Thank you very much, Digant and Saurabh, for joining us. Quick wrap on Bazaar. After a break, it'll be Chartbusters.